Hi, I'm Stuart Jackson, Portfolio Manager at Montgomery Investment Management. Welcome to this week's video insight. The performance of the major bank stocks has improved over the last couple of months after a poor December quarter. The source of the turnaround is primarily a change in the market's outlook for net interest margins on the back of an expectation that Reserve Bank will begin raising its overnight rate soon after the election. Net interest margins have been under pressure as a result of the ultra-low overnight rate set by the Reserve Bank as an emergency response to the COVID-19 pandemic. This impacts NIM in two ways. First, it reduces the bank's funding advantage provided by the deposit bases relative to the wholesale market funded non-bank lenders. Around 2/3 of the funding in the major banks' interest-bearing assets comes from deposits. The interest rate paid on deposits is generally lower than the rate paid on funds sourced from the wholesale markets. However, there's a zero rate floor in the interest rate that banks can pay on deposits, as it would be difficult for banks to pay a negative rate to depositors. With the benchmark RBA rate falling to 0.1%, the average cost of deposits has increased relative to the benchmark 1-month bank bill swap rate used by wholesale markets to price debt that funds non-bank competitor loan books. This impacts banks with a larger proportion of their deposit bases coming from low-rate transaction accounts relative to term deposits, as they hit the zero rate floor much earlier in the rate cut cycle. While the average funding cost of non-banks is still higher than the funding cost of the major banks, the gap has narrowed materially over the last 2 years, making the non-banks far more competitive. This will begin to reverse once the Reserve Bank begins lifting official rates in the middle of this year. Of course, higher rates will likely have an offsetting impact on the demand for credit and potentially loan losses in the medium term. The other impact of lower rates comes from the return generated from the liquids portfolio held as part of the bank's prudential requirements. The liquid assets are generally invested in fixed interest assets like 3-year bonds. As interest rates fall, the returns generated from these securities also tends to reduce. The Reserve Bank's policy of targeting a 0.1% yield on 3-year bonds in response to the pandemic exacerbated this impact in 2021. The banks run a rolling hedge book on their liquids portfolio to smooth the impact of changes in bond yields over a 3 to 5 year period. As a result, material changes in bond yields take years to flow through to the return generated from the liquids portfolio as reported as income by the banks, impacting NIM more slowly but over a longer period of time. The returns generated from liquid assets has been falling gradually over the last few years, putting downward pressure on reported NIMs. However, with intermediate bond yields jumping materially from October last year, the rolling average rate of return is likely to stabilise in calendar 22 before beginning to rise, removing this source of downward pressure on NIMs and eventually providing a tailwind toward the end of this year. Both of these factors appear to be bottoming at the moment and are likely to start to reverse in the second half of the calendar year. This would see net interest margins turn from a drag to a driver of earnings growth for the major banks. That's it for this week. We'll be back next week. In the meantime, you can follow us on Facebook and Twitter.